Welcome back to Private Market Talks, a cross-era podcast where we dive deep into the world of private markets and talk with the people shaping the future of alternative investments. I'm your host, Howard Bieber. Today, our guest is Jason Strife, a Senior Managing Director and Head of Junior Capital and Private Equity Solutions at Churchill Asset Management, where he also serves as Chair of the Private Equity Junior Capital Investment Committee and is a member of Churchill's Executive Committee. At Churchill, Jason is responsible for executing strategic initiatives, capital raising, sourcing investments, and portfolio construction for the firm's middle market private equity and junior capital investment efforts, including fund commitments, equity co-invests, secondaries, and junior debt investments. Prior to joining Churchill, Jason was with the firm's parent organization, TIAA, and subsequently Nuveen, beginning in 2001. Early in his career, he was a principal at Bison Capital, a Los Angeles-based firm focused on structured junior capital investments in lower middle market companies. Before that, Jason held roles at Western Presidio, a private equity firm focused on growth capital leveraged buyouts, and in the mergers and acquisitions group at Wachovia, where he executed sell-side transactions on behalf of private equity sponsors. Jason is a graduate of Wake Forest University and currently serves on the Board of Visitors of the Wake Forest School of Business. For additional background, Churchill Asset Management operates as the U.S. private capital affiliate of Nuveen Private Capital, the asset management arm of TIAA, and has been active since its founding in 2006. The firm provides first lien, unitranche, second lien, and mezzanine debt, as well as equity co-investment, secondary solutions, and private equity fund commitments. Churchill has built a multi-strategy private capital franchise serving private equity sponsors and middle market companies with a focus on industries including business services, healthcare, technology, financial services, as well as select industrial and consumer sectors. As of 2026, Churchill manages over $63 billion in committed capital across credit and equity strategies. In January 2026, the firm announced it had raised more than $16 billion for the fifth vintage of its flagship senior lending strategy. In recognition of its platform and market presence, Churchill was named 2025 Lender Firm of the Year by the M&A Advisor. The firm also recently raised $1.5 billion for Churchill Co-Investment Fund 2. In our conversation today, we'll explore Jason's perspective on structured credit versus private equity solutions, discuss current market dynamics, and look ahead to what may be next for private equity and private credit. As with all our episodes, you can find a full transcript and additional resources at privatemarkettalks.com. And if you enjoyed the episode, drop us a line. We'd love to hear from you. And now my conversation with Jason Strife. Jason, welcome to Private Market Talks. It's great to have you on the show.
Thank you, Howard. It's great to be here. Good morning.
Good morning. All right. So why don't we start the way I always like to, with a little bit of background. You've spent your career across M&A, private equity, and now private credit, junior capital, secondaries. We've got a lot to cover today, but I think it would be helpful for our listeners to maybe walk them through your background and your career path to how you got where you are now.
Sure. Terrific. So I guess you could characterize my career as the traditional investment banking and private equity route. Next year is my 25th professional anniversary in the middle market. So I've spent my entire career since 2002 in middle market private capital roles. Fairly common path at the time in 2002 is do a stint in investment banking, work on both sell side and buy side transactions, get your feet wet with private equity clients and middle market companies, and then transition to a private equity buy side role, which I did. I went to Boston for 2 years as an associate, and then also got some experience in the middle of the balance sheet with structured equity and structured debt solutions at Bison, as you mentioned in the introduction. And then really made a pivotal decision in my career to not necessarily work for a one strategy general partner, which the two prior professions or jobs I had were. They were small management company, one strategy focused private equity complexes, and made the decision to join TI and Nuveen in 2011 and really help catalyze and grow a multi-strategy focused asset management complex. At the time, that wasn't prevalent in the market in terms of bringing private equity and private credit solutions together at scale, and saw an opportunity here in Charlotte to really marry up middle of the balance sheet, bottom of the balance sheet experience into what has now become this full capability suite franchise that we have at Churchill today. So it's a long and windy road, but really have been doing the same thing now for 20 years, which is focused on middle market investing, working with private equity owned companies, both investing and now providing capital in many different forms to the market a fairly common professional route at the time to end up where we are today.
Almost feels like you're a bit of a visionary as to where the market has gone, but that's great. That's good background. Thank you for that. So, why don't you tell us a little bit more about Churchill and Churchill's place in the market and what differentiates Churchill from some of your competitors?
Yeah, happy to. As you mentioned in the intro, the firm is really a middle market focused franchise at scale, trying to bring integrated and diverse capital solutions to middle market private equity firms. So our goal is really to be best in class and full service in our relationship to the middle market US buyout ecosystem as a scaled limited partner to those GPs, and then a balance sheet provider in terms of financings, both top, middle, and bottom half of the balance sheet, as well as now meeting GPs' liquidity needs through secondary solutions. So the firm has a really interesting history, started as a direct lending business, went through various iterations as a direct lender, and then really formed the partnership with TIA and Nuveen in 2015 with the vision of using some of the characteristics and strengths of the TI and Nuveen platform to really drive the business into what it is today, which is truly one of the only middle market focused private capital platforms of scale in the US. There's, of course, a lot of big firms that do a lot of things for the market, but to be able to make the statement that we're focused on the US mid-market buyout space, that's all we do on behalf of our global investor base, that's a unique statement to make in the market. So, one of the things we'll talk about today, I'm sure, is how you differentiate yourself, how you gain scale. And one of those key differentiators for us is the partnership with a permanent capital base. That's been a trend in the market that a lot of managers who were growth oriented, who did not want to be a one strategy, one fund series firm, which there's nothing wrong with that, by the way. There's tons of excellent managers that do one thing really well. But if you want to optimize the scale opportunity, usually in this stage of the market, you need a permanent capital partner. And that's what TI and Nuveen serve as today for Churchill. And we'll talk, I'm sure, a little bit about that.
Yeah, definitely. Thank you. I want to get more into that a little bit later. And again, because since you wear a number of different hats, we'll try to not go all over the place here. I'm sure we'll fail a little bit. But why don't we start with the M&A market and how you are looking at things now from where you're sitting in an environment where the interest rates are coming down, at least for now, but uncertainty certainly isn't coming down or isn't going away. So wondering how you look at that, or how sponsors should be thinking about the opportunities that exist now.
Yeah. Look, I mean, we are net optimistic on the market opportunity today. That is in large part due to the evolution of the middle market private equity GP. And what I mean by that is most are sector specialists, most have human capital resources from a toolkit perspective that are just vastly different than they were when I first joined a private equity firm in 2005, 20 years ago. So the toolkit that the GP has, both in terms of value creation, but also just the operating human capital resources that they can put around a company, are just better. And so we like that profile of owner for a business in a more complex environment. There's a lot of situations where we're seeing an end market today where you might have a portfolio of companies in an end market that, let's just say, some of them are doing poorly, but you see opportunities in the same end market from a new private equity buyer, and that business is actually doing quite well. And it's doing well because the GP has put a differentiated set of resources to bear on that business. And that business is outshining its end market where some of its competitors are lagging or even suffering due to this complex environment you alluded to. So we like the specialist private equity model as the owner and as our capital partner in the market today, more so than ever, just because, as you alluded to, the market is not getting simpler to deploy capital. We are likely in a long duration period where manager expertise is going to drive a lot of dispersion and return and success.
We're going to get into manager selection a little bit later, which is where you're heading, which is very interesting. Let's just for a moment stay a little bit with the M&A. The M&A market now. The market rebounded a bit in 2025. What are you seeing here early parts of 2026? anything telling you that the
Yeah.
rebound is sustainable or not sustainable?
We certainly hope that we're going to continue to see incremental momentum in the market. And I'll give you a few different vantage points from our seat at Churchill. One of the nice things about running a multi-strat shop and having hundreds of private equity relationships and being an LP all over the market is that we have great data. So I'll give you the viewpoint from a couple of different vantage points. One is our fund of funds portfolio of GPs. We've got 125 different GPs calling capital and distributing money back to us on a daily basis. We analyze the ratio of distributions to capital calls all the time as a proxy for how active our managers are being in the market. We own the track record for 15 plus years. We have all the data at our disposal. For 3 consecutive years, really off the bottom of 2022, 2023, the ratio of distributions to capital calls has been improving pretty consistently. And 2025 was the high water mark over those past 3 vintages in terms of a body of work. And so we move into 26 with that momentum of just more happening in our fund of funds portfolio. We like that. Now, where we are as a ratio, historically speaking, is not at an acceptable position in terms of ultimately driving more capital coming back than putting out. So thinking about an acceptable return for that portfolio, we're not there yet. And it seems to be slowly inching towards that level of acceptability. So we know the market needs to transact more because we had 12 years at a relatively consistent ratio. And then we had effectively 3 years where we were way behind that. And so everybody's seen the charts around elongated private equity ownership duration and the like. That's all true. Now we're hopefully seeing that unravel a bit because we've had 3 full years of relatively depressed activity. So that's kind of one. 2 is just our investment banking relationships and seeing book flow, mainly in our direct lending business. So our senior direct lending business is the strategy out of our 5 that certainly has the best barometer on the market just in terms of auction book flow. And the statistics there would also support the case that we are seeing a heightened level of activity into the first quarter of 2026. And then the third is just our own direct dollar activity. So whether it's being a senior lender, a junior capital provider, an equity partner as a co-investor, or a secondaries participant in the market, 2025 was our busiest year as a firm. So now there are other factors at play that are driving that level of investment activity, but that sheer fact that it was our busiest year in terms of deployment, again, thinking about a year over year of progression of activity, for us to be able to make that statement again tells us that there's more going on in the market. Now, I think there's also been a lot of discussion about how fast or reactive are we going to get this kind of snapback phenomenon in the market because of all this pent up demand. And I think that's where my own personal perspective is that we're not going to see that. There's too much going on a daily, weekly basis now with respect to macroeconomic factors, media, geopolitics, et cetera, just a heightened level of complexity and confusion that makes it very hard to see a market that's dependent on a process of selling a business that takes 6 months to do. It's very hard for me to see this kind of hockey stick snapback with respect to private equity activity. I see it incrementally getting better and maybe gaining some steam, picking up some steam, but in an orderly way. And I think the backdrop is what's inhibiting that very quick resurgence that I think a lot have been expecting, including us, by the way. For 2 years in a row, 2024 and 2025, we thought that we were going to see a very quick snapback at some point, and then really led with the announcements last April, the complexity started to compound on itself. And that just, I think, hurt the market's ability to really snap back.
How do you look at the market and its volume and ability to rebound relative to all the sort of GP-led structured transactions, which are providing liquidity in kind of different ways? I'm sure you guys track all that. I'm just curious as to how one kind of dovetails with the other and what you're seeing in that regard.
Yeah, I mean, look, this is a fascinating question because it appears that a technology in the market, GP-led secondaries, gained a lot of momentum at the perfect point in the market when there was a lack of distribution activity. And I'm sure that helped to some extent, right? But we were taking calls from GPs a decade ago about how they could come up with a legal structure and get folks comfortable with conflicts to own the best businesses in their portfolio for 20 years. I mean, I can still remember calls from middle market GPs in 2012 that were asking, how do we do this? Obviously, a lack of knowledge around the product at the time, and there was some reticence to really focus on the development of it. And so, of course, this market phenomenon of distribution activity probably exacerbated the adoption of it. But we think it's a tool that has permanency in the market at this point. And while you might see, due to better buyer and seller engagement and alignment on bigger assets, you might see more assets sell to a third party in an auction. In a lot of situations, though, particularly where you have a seller earning very high multiples of capital on the exit, I personally believe you're going to continue to see a lot of adoption of this. We've only seen it being utilized in about 40% of our GP base so far. So there's a lot of room to run. And we think there's a lot of elements of the trade that make great sense for all the constituents around the trade. So timing was good, as it is for a lot of factors of the market and how the market develops, right? There was definitely some of that convergence of timing in the market driving the acceptance of it. But now I really think that you have a technology that's going to perform and shine for a long time.
Yeah, I agree with you. It's interesting. Like most things, at the beginning, you heard a lot. There was a lot of talk, not a lot of action. And then all of a sudden, market acceptance for one reason or another, and these things started becoming complete mainstream. And I agree with you. There's a lot more room to run there. I think that's the general consensus of the market. We'll keep secondaries for a second. Before we move on to private credit, final question on sort of the private equity market. You have said in the past that you think that the traditional middle market is actually a little bit less crowded than people assume. So what are we missing? What are your views on that?
Look, I think this comes down to how platforms try to differentiate themselves in the market. And I tell our own story about when we were really re-architecting our program to be middle market focused, and we had aspirations to be a scaled co-investment player and a big junior lender in the market circa 2011, and really wrap LP relationships around this direct investment capability franchise that we have. That wasn't new at the time. There were some big competitors with really strong brands in the market that were doing that. And we've had an excellent uninterrupted 15-year run of growing that franchise in a market that folks thought was already sort of saturated with big players. And, I'll give you a couple of examples at the strategy level. We've been hearing a lot, 15 years in a row, in fact, that every institution wants to co-invest more alongside GPs. And that's true. There are a lot more institutions that want to co-invest. But we went from doing nothing to $1 billion a year of direct equity as a co-investor, with some pretty high demand in terms of brand names, in terms of their own cachet, the GPs in the middle market space. And there's a lot to doing co-investment successfully at scale. And I'm sure we'll get into some of those execution success factors that you need to bring to bear consistently. But the market is not overcrowded when you position yourself a specific way to the market as a co-investment partner. Same thing with private credit. Private credit, which I know is our next topic, there's a lot of different flavors of private credit. And when you drill down and dissect where managers are deploying and what they're trying to deliver in terms of a return profile to their investor base, a lot of different shades of private credit. And in our specific focus area being mid-market buyout, I do think that there's been more competitors that have moved upmarket than have stayed true to the middle market. And so when you overlay that competitive dynamic with how GPs actually evaluate and ultimately select a lead lender in a fast-paced sell-side process, they're not canvassing the market for 15 different lead left lenders. They're going to a handful of proven relationships that speak to them with many different products, who have had the same faces talking to the decision makers at that GP. And all of those characteristics of the relationship matter a lot. I feel like our direct lending business is actually situated better competitively today in 2026, despite all of the money that's been raised around the private credit space. And so co-investment in private credit, I kind of see as the same way. It depends on the nuances of your platform and how you approach it.
That's interesting. Thanks for sharing that. So let's move into the private credit side now. How do you guys think about credit selection in the
Hmm.
environment that we're in today, where defaults remain low,
Yep.
refinancing risk is higher given where the interest rates are going? So how do you guys think about your credit selection?
Yeah, we get this question actually quite a bit from our investor base and from our parent organization in terms of their direct allocation to our respective strategies and how we service them as a sub-advisor to the general account. And that question of what are we doing differently today, the answer is not going to excite you that much because we just aren't doing much different other than I'll call it a modest reprioritization of our diligence issues. The playbook has always been deeply diagnostic with respect to what we're trying to learn about a situation, but there's a hierarchy, if you will, of issues that have varying degrees of impact on a situation. I'll give you a couple of examples. Adjustments to earnings, much more scrutiny on that today when your organic growth playbook for a middle market company is far more opaque in a market like today. When everything you're seeing from the market has a herd mentality, right? A sector trades, and then you start to see some competitors get unlocked out of private equity portfolios. And so there's examples of end markets where you start to see a lot of velocity. In a cleaner economic picture, you might be willing to accept adjustments with a little bit more latitude because the profile of those adjustments and the leap or the visibility you need to get comfortable with them is easier to make. Today, that is close to impossible with most adjustments that relate to growth. And so those aren't going to be accepted. They're going to be more scrutinized. And so we sort of reprioritize those as sort of table stakes to getting involved in something. So kind of cleanliness of earnings, if you will. The new big topic is, of course, how is AI changing human capital businesses in specific sectors? Do human touch elements to business models go away or become less relevant because of AI efficiency opportunities that companies can make? So we're doing much more evaluation in the market with experts, with GPs in our portfolio who have expertise in technology. But again, we were always doing that business model diagnostic. It's just that has a heightened level of focus today because of the environment that we're in. So I always think about our approach as very comprehensive, deeply diagnostic. We're always trying to get comfortable with 6 to 10 different areas of diligence, but depending on the market that you're operating in, there are certainly priorities. That range of priorities, if you will, or that rank order moves around a little bit, but we're really not doing anything different from a diligence perspective because the opportunity is more complex. We've always prided ourselves on being a deep due diligence shop.
What about structuring transactions? Are you
Yeah.
seeing more creativity, capital stacks relative to the past?
Absolutely is the answer. We're talking our own book a little bit because we're a junior capital provider too, right? We like to provide GPs a menu of options because each situation, value creation goals, capital expenditure needs, interest rate environment, as you alluded to, all of that matters to us as a capital provider when we're thinking about is the GP capitalizing a business in the most opportune way for the situation. So we gravitate towards the GPs that really think hard about this. And we, in turn, as a diversified capital provider, want to give them the menu of options. So bifurcated capital structures, coupon orientation that might have accrual features, a lower cash pay burden on the business, and a higher equity orientation or a middle of the balance sheet security. And I would say, again, just generally speaking, in a market that's more complex, where you just have less visibility and confidence in achieving a budget or a strategic plan or these 3 value creation opportunities as a private equity owner, we like the net defensive capital structure. So it might even be a senior debt only, stretch senior only solution, but we want to make sure that that detachment point as a multiple of EBITDA makes sense for the situation. It might actually make sense that the GP should exhaust the full balance sheet capacity of the business, but that better be in a situation today where you have unbelievable confidence in the business model. The revenue is bulletproof. The client retention is exceptional. All those KPIs that you would look for a fully levered balance sheet. So that can exist today, but in most situations, we're seeing GPs thinking more creatively, asking us more questions about the art of the possible with respect to capital structure. And we like that dialogue because we think that's appropriate for the market.
So let's flip a little bit now to, your role as portfolio manager and
Mhm.
working with LPs. When I started doing this years ago, there wasn't a lot of LPs investing in the sort of private credit market, at least not through funds. And now, of course, there is. So I guess from your conversations with LPs, how has the role of private credit evolved within institutional portfolios over the years?
Yeah. Well, I mean, at this point, you could call it a steadfast, reliable allocation in an institutional portfolio. There are excellent options in the market that have 20-plus year track records of doing high diversification, consistent deployment in direct lending. And now we've moved beyond I have my relationships, I have this allocation that's been performing. It's going to be a consistent part of my allocation program. Now it's, what are the flavors of private credit? How many managers do I want? And what format of capital do I want my relationship to be with this manager? And I feel like that is where we are today. Just thinking about the middle market alone, you have private credit that's focused on middle market private equity, you have independent sponsor, you have more opportunistic strategies that really start to get into complex situations or junior capital or pure distressed. And so building that, what I like about the market today in private credit is that there's a lot of different options to build a diversified portfolio of strategies. I think the core is still your middle market or upper market kind of direct lending solution. And then you build different smaller allocations or modules around that have different risk return attributes. And so that's where I think the market is today. You have to be really flexible with respect to your format of capital and your relationship with some of the LPs in the market that have a lot of scale and that drive a different type of relationship. So whether that's fund of one or SMA type strategies or structures, that is where we are today. The evolution is now, how many different strategies within my portfolio do I want? How do I optimize sort of risk and return for my own risk appetite? And in what format do I want that capital to be allocated to this GP in? And that's really where I think the market is today.
I want to get into co-investments. Typically, we talk about those on the equity side. Have we gotten to that place on the credit side yet?
Look, I think it's all about, we do have some relationships with institutional LPs that are looking for co-investment opportunity. In my mind, it's the same approach. GPs expect direct lending relationships to have speed, certainty of execution, scale, committed financing capabilities, the like, all of that. You need to do all of that perfectly, right? To be a best in class lender in the market. If you have the ability as a platform to speak to the market with that level of certainty and uninterrupted certainty and bring co-investors into a situation, I do feel like that is a part of your, again, us as a GP now, bringing that co-investment capability to the market, as long as it does not disrupt our relationship with the private equity client and being a best-in-class scale committed financing solution, and you can, as a platform, structure it the right way, there are demands for co-invest. Yes.
Let's now flip over a little bit to the traditional
Mhm.
co-investment. Another thing that didn't exist when I started the traditional co-investment, the equity market. I'm curious, and you're on the ground on these deals. Now, as you said earlier, right? Every institutional investor says they want co-investment rights. Typically, during a fundraise, they get some form of it, whether it's
Mhm.
guaranteed rights or just sort of an understanding. But what really determines who gets a seat,
Yeah.
like a seat at the table, and who can actually execute these deals?
Yeah, look, I think there are a lot of flavors to the co-investment market. The way we look at it is, if you can marry up a number of different characteristics with respect to our platform, and we can bring those to bear in a transparent way to our GP partners, we can outrun and outmaneuver most of the competition. There's many great scaled platforms, but the beauty of the market, given how big it is that we all seem to have our different set of key relationships, if you will. Our 125 are different than somebody else's 125. And that's the beauty of the market. But if you can think about marrying your scale on a per deal basis, the speed and structure of your underwriting as a partner to a GP, your platform structure with respect to investment committee transparency, and your own people in terms of their skill sets and their relationships with the decision maker at the GP in terms of who they want to be their co-investment partner, I think that you can really differentiate yourself. If you have a unique relationship with a decision maker and your relationship has both fundamental economic relevance to it in terms of being a large LP, that opens the door for dialogue, but it really doesn't do anything for you if you don't have the mindset of being a committed financing partner, much like a direct lender would be, but in an equity co-investment context. I also feel strongly that the continuity of that relationship between our key people and a GP's key people is very important to driving that. So from the very first dollar of co-investment we put on the ground 15 years ago to today at deploying $1 billion a year of co-investment capital, we've always had the same IC structure and transparency to the market so that we could move as quick and as nimble as the market demanded. And that's a big factor. But there are other characteristics that I think you need to marry up to make that all work.
Yeah, I was going to ask you what's changed over time. On the one hand, being able to prove to managers that you can execute in a timely manner, obviously helpful. On the other hand, there's a lot more people who are trying to get into the co-investment business, or at least say they are over the years. So I guess, how do you marry those two?
There's definitely more co-investment available in the market. So I do think GPs value the co-investment technology more in the market today as it relates to sizing their own pool of committed capital. We love managers who think about portfolio construction like we do. We don't want a GP to own 15 companies with 2 of them consuming 30% of the fund's committed capital and then 13 others that are much smaller holds. You start to do some of the outcome math on that. And if the wrong deal goes the wrong way, you really ruin the fund's ability to drive a private equity return. We like consistency of deployment. And so tailoring your check size to the right size fund, and then acknowledging the fact that if you do have larger situations that require larger equity checks to bring in partners, I think that mindset is adopted by more GPs today than it was 15 years ago. So there's definitely, the market is just fundamentally bigger. But then I think also from an allocator's mindset, there are a lot of institutional LPs that are just ill-equipped from a people perspective to move with the execution prowess you need to be a scaled co-investor. So there's nothing wrong with taking co-investment after a GP closes a deal and then they're doing an allocation of co-investment. That can work. We take an opposite approach because we're thinking about seeing the most opportunities and driving a pretty curated funnel down to what we actually co-invest into. So we want to create the most opportunities and be on the front end. You need a team of 30 to 40 people to do that. You can't do that with 3 people. And so the human capital model of the LP also drives where you position yourself tactically as a co-investor in the market too. So there's just a bunch of different ways you can play the opportunity.
Got it.
Yep.
All right, so let's put on a different hat for you. Your hat is sort of manager selection, analyzing other PE managers on behalf of your client.
Yeah.
What's your view in terms of, with all the experience that you have, what separates the top quartile managers, the real top quartile managers? Most everybody says they're in the top quartile one way or the other with some creative math, but what separates the real top quartile managers?
Yeah, interesting question. Look, we go back to a set of core principles that we think have worked, and a lot of it's around the ability to tell a story around consistency of relationship and consistency of people that own that track record. So we're looking for managers, and we try to strive to be one of those managers because we have this great job of having our LP and our GP hat on every day. It's quite fun. And the consistency of our team and the people that have built those track records is very core to our success. And so we look for the same thing in our private equity managers. But beyond the human capital side of it, it's a very fundamental concept of doing the right thing around raising the right amount of money and deploying consistently in the market. We have seen many instances, the mid 2000s, 2021, 2022, where we've seen some managers fall in love with raising a lot of money very quickly, growing their fund multiple times over in subsequent fund iteration, and then deploying money very quickly in concentrated vintage type of funds. And in the heat of the moment, when the market is looking very clean and easy to understand, that might feel good at that point. But when you look back, almost always tells you the same thing, which is consistent diversification, the right lens on portfolio construction, being thoughtful about how much money you raise. And when you tell that story to the LP network out in the market, why you're raising this amount of money, and having sensibility around that, and then deploying it in a systematic, consistent way. You and I are talking to that. Those are not novel breakthrough comments, but they are ignored a lot in the market. And the swings of the market really drive manager behavior. And so being able to tell that story around discipline, I think gives a platform a lot of credibility when they're raising money. And so we are seeing some of that dispersion. Benchmarks are good indicators, right? You can't just rely on benchmarks to make decisions, but they are illustrative, particularly when they have dispersion. And they show you why some managers aren't meeting the demands of their LPs' return expectations. And a lot of it has to do with vintage concentration, timing the market wrong, raising too much money at the wrong time, and then not having capital to really exploit opportunities or seize on opportunities that present themselves in a more complex environment. So nothing particularly earth-shattering there, but we learn a lot from the GPs that come into our shop for our fund of funds program. And we've done a nice job of understanding how the market really gravitates towards having consistent human capital, low turnover models that own the whole track record, don't do funny math with respect to carving out people or track records and the like, and then tell a very consistent story on how they deploy. We're huge believers in that.
So I was going to ask you about mistakes that managers make, but I think you covered most of them. And that sort of GP succession leading into my last podcast was entirely on GP stakes.
Okay.
So I guess wondering your view on, well, succession and how private equity managers, are they typically good, bad? How do they deal with it? And some stories maybe you've seen that you can share, but also your feeling on GP stakes deals. Are they a sign of misalignment or are they a badge of honor? I've heard both, and certainly they're not going away and they're a much larger part of the market.
Yeah.
They've been in the past. So what are your views?
One of the key characteristics that makes a platform an attractive GP stake candidate is the GP's ability and wherewithal at the top of the house to think about that issue in a responsible way. And we've certainly seen in a smaller middle market fund context, one strategy, buyout focused managers. We talk about this a lot, and it's a hard question to answer with precision when you're making a commitment to a manager, right? So we talk a lot about the personalities of the folks at the top, the economic dispersion of the management company, asking questions about succession, and you're making an educated guess. And look, we've seen that go the wrong way for some GPs without, of course, mentioning names on the pod. We have seen it go very badly for managers that did not get in front of this and that weren't thoughtful about taking the right sort of democratic approach internally to really architecting out the future. But conversely, perhaps maybe because the GP stake market exists today as a liquidity mechanism to having a sophisticated partner in a private capital franchise, thinking about a private capital business as an operating company and bringing investors in to give you liquidity. Perhaps GPs are thinking about it more and being better at it today because there's an opportunity to monetize what they built with a GP stakes partner. If you don't have it blueprinted and have thought about it the right way, you are not a candidate for the GP stakes platforms. We know many of them. We have one of them as a partner of ours. And this issue, 1 or 1A for them in every situation. So there's clearly evidence of it where platforms have done it really well. I wouldn't be surprised if managers told you that they think about it more because there's a stakes and partnership opportunity in the market to extract some level of liquidity out of what they've built. But we still see it go badly because the founder has the wrong personality or the wrong outlook on where they want the franchise to go. So in terms of your question on, is it a badge of honor? We're proud of the fact that we could have attracted a GP stakes platform and a co-investment partner to that stakes platform into our business. I think it does tell you a lot about the risk profile of that platform, how diversified we are. It tells you a lot about the people that run the business and how we think about talent and retention and culture. It tells you a lot about performance because all of these things are critical success factors of thinking about a 20-year investment. That's what a stakes manager has to do. And so I think it's a nice acknowledgement of a manager's ability, both on the quant side and the qualitative side of their business, to be best in class. So yeah, I think it's a net, it's a badge of honor.
So it sounds like everything else, it depends, right? If you're doing it for the
Absolutely.
doing it for the right reasons and you're prepared, it can be a very, very good thing. If you're doing it for the wrong reasons, it will not end well.
Yeah, look, I think that's right. And portfolios of GP stakes are incredible pools of assets when you think about them for the market in terms of using that pool for capital raising. It's a wonderfully diversified, hyper diversified, if you will, across GPs, strategies, geographies, different jurisdictions. It's a wonderful asset pool to do creative financing things too. So we like the development in the market. It's helped our business with respect to its growth prospects, and I think is absolutely a point of validation for the market.
All right, we're getting close to the end. Let's get the crystal ball out.
Okay.
So tell me how you're feeling for 2026, just for the listeners to know what's feeling different, what's feeling the same, where do you think we're heading?
Again, I'm a net optimist for 2026 being a busier year for the market. And you have to be very in tune to what's going on right now in terms of there are so many different shades of complexity impacting each investment situation or opportunity that comes into the shop. I mean, I think you really have to have a heritage and a platform and a focus that's been built on asset level expertise in terms of really knowing what's going to drive success. And we feel fortunate to be partnering with a lot of best in class private equity GPs to help us navigate that course. I think we're likely to be continuously hearing about events or news bits that are akin to what occurred in April of 2025. I don't think that's going anywhere. I think the market is now kind of living with that reality to some extent. I'm hopeful that some of the elements of the market that we've talked about structurally, interest rates, cost of capital, private equity, ownership duration. I think the market is well structured fundamentally to have a good productive year. We're just all now driving that productive year with more to be concerned about. That will ultimately create opportunity, but it will also most likely weed out winning and losing platforms when we look back at this time period.
All right. So closing, what I always like to do, best advice
Yeah.
you've received on your career. I like to think I've got some young listeners here, so we're interested.
Yeah. Well, this is a story from when I was a very young professional. So I have two kids that are 14 and 16. I've told them this story a couple of times. So as I mentioned, I did the investment banking stint. I did it for 3 years. I took an extra year of paying, not just 2 years. And my very first summer, I was on my first assignment and thought that I had done a reasonably good job at something and had left on a Friday to go visit my wife now, but girlfriend at the time in Atlanta. And I got this call from my boss, and I'll never forget what she told me. And it was such good advice to get at that time because it sort of put me on a different career path in terms of how I thought about the repercussions of what she said. And she was angry at the work product. And she said, look, this is very simple, but you are not in college anymore. She said that very, very cleanly, very bluntly, you are not in college anymore. And it sort of woke me up to and you're in professional services like I am, this is just a totally different standard of how you need to think about your work product at the micro level in a client focused business. And it hit me inside. And I was only 22 years old or 23 at the time. And it really helped me when I was very young think about this as okay, I've been very fortunate to get this job in a highly demanding investment banking program. I got to make the most of this every second that I'm a part of it. And it really put me on a different path to think more like a professional sort of adult very early on in my career. So I'm glad this individual said that to me.
I ask everybody the same question and I always get different answers, but I will tell you, if anybody asked me that question, that is what I often tell our junior lawyers.
Oh, really?
What I say is this is not homework anymore, right? This is professional purposes, and there's a very big difference. Exactly. Yeah, that's great.
Yeah, that was 24 years ago.
So, okay, when you hire people, how do you figure that out? What are you looking for?
Yeah, look, I mean, we consistently hire junior talent, and it's not just in investment disciplines, it's product development, capital raising, and the firm is very, very big believer in giving junior talent the opportunity to shine internally as a presenter, as a vocal contributor to what we do as an investment platform. And so our associates are speaking in investment committee situations, they are talking to investors And I think that's part of our culture, is giving opportunity to junior folks and putting them out of their comfort zone very quickly. And so to enable that, the backgrounds of your people can't just be expertise in just the skills to do the technicals. And so we see a lot of technically proficient people, unbelievable resumes. Everybody always talks about how they could never get into the college that they went to because resumes just look differently. And that might all be true in some circumstances, but we are looking for folks that are thinking more about being well-rounded, and particularly in a market opportunity that we give where you need to be outward facing a lot as you mature and become senior in the role. You get those skills when you're junior and you're uncomfortable, so that when you're talking in a setting like this, it feels natural. And so we are looking for those folks that not just thought about being highly proficient and having all of these certifications and being technically proficient in what we do, but being excellent speakers that can hold a genuine, honest conversation. That matters a lot in this business.
I'm sure every business. Yeah. Thank you. That's great. That's good advice. Thank you for joining me today.
Thank you.
Yeah, this has been a great conversation. Any final thoughts you want to leave our listeners with?
This has been a wonderful opportunity for me, Howard. I really appreciate the opportunity to tell you a little bit about the Churchill platform and what we're seeing. I really enjoyed it. So just a genuine thank you for having me.
Good stuff. Good stuff. All right. I'd also like to thank our listeners for tuning in today. And again, if you've enjoyed the episode, drop us a note at privatemarkettalks.com and keep an eye out for our next episode coming your way next month. Thank you. And thank you again, Jason.
Thank you. Have a great week.